In previous tutorial, I talked about what is an index. So in this tutorial, I am going to talk about some weighted methodologies of indexes, or in simple terms, different categories of indexes or indices. So there are typically three types of indexes. The first one is price weighted, second one is market capitalization weighted, and the last one is equal weight. So I'm going to explain each one of it one by one. But let me first start by price weighted. So you can just read the definition and pause the video and I'll explain after that. So a price weighted index is an index in which each security, or as we are talking about stock market, so each stock have weight or importance in the index according to their respective prices or in proportion to their stock prices. So what I mean by that is, the higher the stock price is, the higher will be the weightage of that stock in the index, and vice versa. Price weighted index value is calculated by adding the price of each stock and dividing it by the total number of stocks. So let me give you an example of that. For example, there are 5 stocks with prices of $10, $20, $30, $40 and $50. So the number of stocks is 5 and the total price of all these stocks is 150. That is 10 plus 20 plus 30 and goes on till 50. So the value of the index would be 150 divided by 5, that means 30. And the weight of each stock will be price of the stock divided by total price of all the stocks. So the minimum weightage company will be company A, because the share price of company A is $10, which is least out of all the companies in the index. And the company having the maximum weightage will be company E, because the share price of the company E is the highest among all the other presented in the index. And Dow Jones and Nikkei 225 are examples of price weighted stock market indexes. And some advantages are these, you can read it. And also some disadvantages are this. I'll provide you the advantages and disadvantages in the resources section. Second one is capitalization weighted index. Again, you can just pause the video and read the definition, and I will explain afterwards. So a capitalization weighted index is an index in which stocks are given a weightage or importance in proportion to their market capitalization. So higher the market cap of a company, higher will be the weightage in the index, and lower the market capitalization of the company, lower will be the weightage. Here the value of the index is calculated by adding the collective market capitalization of all the stocks included in the index and dividing it by the number of companies. So for example, there are 5 companies, namely Google, Microsoft, Apple, Facebook and Alibaba, with their respective market capitalizations written $100 to $500 billion. First of all, the value of the index would be total value of all the companies, that is total market capitalization of all the companies would be $1,500 billion divided by the number of stocks, that is 5, which means 500 would be the value of the index. Now coming to the maximum or minimum weightage of the companies. The minimum weightage company will be Google, because it has a market capitalization of $100 billion, which is the least among the 5. And obviously the maximum weightage company would be Alibaba, because it has the highest market capitalization of all the companies in the index. And some popular market capitalization weighted indexes are S&P 500, Hang Seng, Nasdaq, Wilshire, etc. And capitalization weighted index has one subcategory called float adjusted cap weighted. So float adjusted cap weight index is a type of cap weight index which typically means the companies in the index will be weighted just like market cap weighted index, But the market capitalization should be considered on the shares which are available for trading. So usually there are companies in which there's some major shareholder or another company holds a significant stake who are in no worry to sell the shares in near future. That is, either there are large companies or there are some major shareholders who don't want to sell in the near future. So those are not available for trading, and the index will not consider those shares included in the market cap. So for example, a company has 100 million shares but an individual holds 20 million shares. That is, for example, a promoter holds 20 million shares, which equals to 20% of the shares. So in this case, a float adjusted cap weighted index will use 80% of the company's market to determine its place in the index. Because the 20 million shares that a promoter holds are not available for trading. That means only 80% are left available for normal guys or for the public for trading. So some advantages are and some disadvantages are this. And coming to the last one, that is equal weighted index. So it is an index which gives equal importance or weightage to all the stocks included in their index, irrespective of their market capitalization, size, price, or any other factor. A 10% rise in a large cap stock has an equal impact to a 10% rise in a small cap stock. The Ridex S&P Equal Weight Exchange Traded Fund is an example of equal weighted index. Due to daily fluctuations in the stocks, the portfolio is constantly balanced to keep the positions of the stocks in equal proportions. Usually these types of portfolios have higher churning, that is, buying and selling is done on a frequent basis. And so this index includes higher trading cost. Some advantages are and some disadvantages are. And this is all for this tutorial, and if you have any doubts then ask me in the discussion forum and I'll get back to you.